Hi, everybody. We're just going to give everybody a quick minute as people come onto the webinar. Thanks so much for joining us today. See numbers just climbing here. We'll get started in just a minute. Thanks so much to everybody for making the time to join us today. I see our numbers are still climbing and it's right at noon, so we'll just give everybody a minute and then we'll jump in. Everybody, just one more minute. These numbers are still climbing. Okay, I think out of respect for everyone's time, we're going to get started as people continue to come on. Thank you so much to everybody for joining us today. My name is Sarah Lefton, and in addition to being the Chief Development Officer at UJA Federation, I'm the Executive Director of the Jewish Foundation, and really looking forward to this webinar today and to sharing with you some of the highlights from this past year, and also having two of our incredible partners, Stacy Rosen in Texas, Hamilar, who are on today to speak with everybody. So I'm just going to jump in now and just share a few things for how we're going to work on today's webinar. There are questions that have come in from everybody who's on in advance, who have sent in questions in advance. Thank you to those of you who have already shared things that you want to hear more about. We have those questions. We will address some of them in the presentation today. And then we will also have an opportunity for people to ask additional questions. If you click at the very bottom, you'll see a tab that says Q&A. And throughout the seminar today, you'll be able to add in different questions that you want us to address throughout the call. So please feel free to share and to jump in. And we'll also, again, capture the questions that have already been sent to us. The purpose of today's seminar is really to run everybody through some of the incredible highlights that we've had this past year. There's been quite a bit of growth, not just in assets under management, but also in the way that we are actually doing things, the way that we are working with our advisors, with our fund holders, and the way that our advisors are working with so many of the different Jewish philanthropic families in our community over the past year. So I'm going to speak a little bit about that to kick off today. We're also going to hear from the chair of our investment advisory committee, Stacy Rosen, and she's going to talk about our investment strategy at the Jewish Foundation, some of the returns that we've seen this year, and answer a number of questions that have come in about our investment strategy. And then we're going to hear from our partner, Texas, from Mercer, who really is not only our research partner, but our key advisor, working with the committee of lay leaders, volunteer leaders who are guiding sort of our investment strategy and approach. So we'll hear from Texas as well with some details as to how he is guiding us through our approach to how we invest the funds in the Jewish Foundation. So just to start, I do want to comment and just say this is one of the first times that we've had a webinar where it's not just our core fund holders who are joining us, but we have some people who are newer to the Jewish Foundation as well. So thank you for joining us. And if you have questions about how we do things and you're considering either moving a private foundation in or you're considering opening a donor advised fund, we're really happy to chat, not just obviously throughout the webinar today, but after this call as well. There have been so many people making changes in the way that they structure things, especially in the last 2 years, as they potentially may be giving more Jewishly, or they've been frankly facing an absolute tidal wave of asks from smaller Jewish charities, larger Jewish charities, both based in Israel and in Canada. And one of the things that we've been doing at the Jewish Foundation is really trying to help our families, both who have funds and also who are coming to us for advice, navigate some of those asks and actually vetting projects and providing them with details about core areas where they're looking to make a difference. So I just wanted to sort of highlight some of the ways that we do that as we come in. Many of you have been involved in the Jewish Foundation for years and years, some of you even decades. And you know that the Jewish Foundation and the assets under management have grown significantly, particularly in the last 5 years. So until about 5-6 years ago, we had about $500 million under management. We now have we've way surpassed $1 billion of assets under management, which is really a remarkable thing. But isn't just because of the fact that we've gone out and we've been soliciting new donor advised funds. Actually, what we've seen since October 7th is a real movement from Jewish philanthropists who are looking to come together and make a difference together, either join up and hear what other Jewish philanthropists are doing, which is something that we can share, interesting projects that are coming to the table, but they're also looking at how they can become more intentional in their giving. And so that's really how we've started to change the services that we offer at the Jewish Foundation. Some of you have advisors at the foundation that you've been working with day in and day out, or frequently throughout the year. At the same time, you know, and you've seen hopefully that we've launched a very user-friendly portal so people can go on and actually make their own grants, grant recommendations through the portal. So you have but two tracks. You can either go online and recommend a grant, and it's really, really easy to now give money to a charity of your choice. But at the same time, if you're looking for more information and there are projects and charities that are coming to you and you don't know if they're the most efficient way to deal with a particular area or concern in the Jewish community, we are here for you. And we are really happy to provide that advice or even share with you questions that we would ask when evaluating an initiative. And we've done that really in a very thorough way, particularly when it comes to grants in Israel, when there are hundreds and hundreds of different organizations and you don't know where to start. We have a full-time team on the ground, really happy to provide ongoing advice, questions, things like that. We will never tell a philanthropist not to make a grant or to recommend a grant, but we will absolutely provide you with questions and things that you might want to consider as you're doing your own research. And we're happy to provide you with information that we have. So in the last couple of years, you have seen that we've made this sort of transition in how we work from simply talking about our fees, which we try to keep very, very reasonable to allow more money to go out to the community and community priorities, and also our returns, which we're going to hear about today, which have been quite positive. We've moved away from just talking about those things to also talking about how we can help families become more intentional. And that can happen in different ways. Our advisors at the foundation can sit down with your families and have a conversation with you and your spouse, with you and your children or your grandchildren to identify values that might guide your giving, but really taking a holistic approach at the beginning of the year to move from what we'll call reactive giving, which everyone does and is not a bad thing. When someone comes to you and says, hey, can you support my a dinner that I'm doing, or can you support this hospital I'm involved in, or this project in Israel? All of those are things that we want to make space for, and a philanthropist wants to make space for. But there's something incredible that happens when a family gets together at the beginning of the year and says, with potentially their next generation or even 3 generations, what are the big things that our family really cares about that we want to achieve this year? And that can happen whether you're giving away $10,000 or $10 million to sit down and say, we have an opportunity as a family or as a fund holder to make an impact this year. So if we sort of put you in the driver's seat and say, spend some time really thinking at the outset about what your intentions are with your philanthropy, that allows your philanthropic advisor at the foundation to help you and say, you might have heard, and you might not have heard about really interesting projects in certain areas where there's a massive impact because there might be matching potential impacts. There might be matching dollars available, or there might be new initiatives that are frankly leveraging new technology that you might not have known about, or whether we know that the government will invest if we put seed funding into something. There are so many different things that we can bring to our fund holders, but it all starts with sort of you asking yourselves and your families those questions at the beginning of the year about what might be interesting to you. So that's the kind of personalized philanthropic support that we're offering. And I urge you, with absolutely no pressure at all, to reach out to your advisor at the foundation, your key contact at the foundation. Again, we will go and we will seek out initiatives that satisfy the criteria that you are looking for. We are not different from what Texas is going to talk to you about in a moment, where we really can act as an advisor and help you make sure that you get the best return on investment for your philanthropic dollars that you are spending. So I just wanted to highlight that and say, please reach out. We would love nothing more than to work with you and to help you and your families sort of really set your philanthropic intentions for the year and then figure out the best projects that you can invest in the Jewish world. Just another note before we move on, upcoming events. So we have a Big Pack seminar taking place on May 5th. We have our Book of Life celebration on May 14th. Mark it down. It's going to be, last year we had our biggest ever at just under 1,000 people. And this year, you are in for a real treat. We will unveil our incredible speaker shortly, but really one of the most beautiful events that takes place in the community each year. If you haven't thought about telling your story, again, doesn't matter if you've left a legacy or committed to a legacy of $5,000 or $5 million or anything in between. But it is a beautiful, beautiful chance to tell the story of the values that drive your philanthropy, your giving. And so I encourage you again to reach out to us and let us know if you want to share your story in the Book of Life. And last but not least, we will have another fund holder briefing on June 17th. This is something that we've been doing more of the last year, and you'll see even more from us along these lines. These are big briefings that we are starting to do for fund holders at the Jewish Foundation, where we are bringing together experts in a particular area and allowing you to ask them questions directly about different projects that might be of interest, or frankly, just getting a briefing on research that underpins philanthropic choices. So as an example, the first one we did was on anti-Semitism and security. We brought in leading experts to talk with our fund holders about Canadian public opinion on anti-Semitism and basically how we can actually make a difference, put some money in, and then measure impact in those particular areas. And people had a chance to kind of rotate through tables and ask questions of different planners and experts in that space and learn about different projects that they might want to grant to. In the last one that we did it around Jewish identity, camping, PJ Library, things like that. And you'll see more from us coming up, and we'll do them thematically. So we'll likely have in the coming year more on social services. If someone wants to come in and really understand what are the biggest issues in our community right now facing the vulnerable, so mental health, housing, food insecurity, those kinds of things, there'll be opportunities for fund holders to come and just to learn with absolutely no pressure of making a philanthropic commitment. So last but not least, before we dive into the investment portion of the seminar, just to look at our results for this year. We've had a remarkable year thanks to so many of you who are on the call today. We've had more than $150 million in contributions, really, truly unbelievable. You see here that we're now $1.06 billion of AUM. Really, really remarkable. And we have some really big things in the works to try to see if we can scale that. Obviously, that allows us to tailor our investment strategy differently, which you'll hear from Texas. And the bigger that we get, the more sophisticated we can become, both in the way that we provide services for fund holders, our digital platform and things like that, but also the investment opportunities that are available. So really quite remarkable to see the growth that we've had. Also, another important number that we didn't report on in the past, but is incredibly important, and frankly is the raison d'etre of the Jewish Foundation, is the amount of distributions that we are making. And that is really going to how we're helping the Jewish world. And we know we have fund holders who can make grants to Jewish or non-Jewish causes. None of that is changing. You can make recommendations to go to any CRA charity that aligns with the goals and objectives of the foundation. But in addition to that, we really are looking at how we are making an impact in the Jewish world and how much money we are sending to Jewish community priorities. And you'll see that those numbers are up in a really remarkable way and in a time where our community needs it most. So thank you to all of you who are not just putting money in the foundation and trusting us to grow those dollars, but also those of you who are sending money out of the foundation to make an impact on the Jewish world. So thank you to everybody. And with that, I'm going to turn it over to our experts for today. And we have Stacy Rosen, who's with us, and who's the chair, as I said, of our Jewish Foundation Investment Advisory Committee. And we're so grateful to Stacy. This is a volunteer role, although she treats it like it's a professional role and has poured her heart and soul and so much time into this, which we can see from our returns. And also Texas. And Texas, I'm going to have you say your last name because I'm not pronouncing it properly, no matter how many times and how many years I've known you. But Texas is going to introduce himself in a quick moment, and who's a partner at Mercer and has been really working with us for years to make sure that we are getting the kinds of returns that we want to provide for our fund holders. So over to you, and thank you so much, both of you.
Thank you, Sarah. I'll take it over from here. Thank you all for joining us, for tuning in today. Since I know we are competing with your busy day jobs, well, seriously, actually, you probably weren't going to get much done today anyway. I know we're all searching Olympic coverage, rooting for Jared Firestone on the Israeli skeleton team in his first heat today in Italy. So thank you really for being here, and go Israel, go in the Olympics. Back to matters at hand, and we can probably flip to the first slide, slide 8. Thank you. Um, as Sarah mentioned, my name is Stacy Rosen, and I'm the chair of the Jewish Foundation's Investment Advisory Committee, known as the IAC or the committee. This is my 7th year on the committee, 2nd year as chair, and in this capacity, I'm also a director on the Jewish Foundation board. Outside of my role here on the IAC, professionally, I advise financial and investment companies on strategically managing risk. Over the next 10 minutes or so, I will highlight the Foundation's investment objectives and results, and the people, processes, and strategy involved in managing the investment portfolio. And then later, Texas and Sean from Mercer will speak about what to expect in 2026. And dare I say, since my role is to tell you about the meat and potatoes that goes on behind the scenes making this portfolio rock, which can be rather dry material at times. This year may be my last year. They'll keep me in person. I expect by next year I will be replaced by an AI avatar or some other proximity. Okay, so now on to our exciting content. The Foundation's investment policy is highlighted on the screen here, as set by the IAC and approved by the board, really drives our investment objectives and has 4 main components. Number 1, earning enough to offset annual charitable distributions. 2, keeping up with inflation. 3, outperforming the cost of managing the portfolio. And finally, building reserves to grow the portfolio to support your philanthropic giving for future generations of our community, as Sarah referenced. So these objectives drive how we invest the Foundation's portfolio. When we translate those words into numbers, we get that number on the bottom in the blue bold white letters. We are targeting a long-term of 7% per year. Since markets and opportunities fluctuate year over year, we look to capture significant upside in the good years and to dampen volatility and hold on to previous gains in the challenging years. We focus on compounding long-term results through robust and resilient portfolio construction. So on to our results achievements. With the 7% plus as the portfolio's long-term objective, we are pleased to report the Foundation's actual results, all as at calendar year end December 31st, 2025. So that is different than what Sarah referenced. Her year end was the fiscal year end as of the end of June. This here in the light blue on the left, you'll see the 1-year return came in at 14.6%. Now, in this webinar, I cannot see any faces, but I hope we've got a few high fives and smiles out there. We're pretty proud of that for the last year. Now, moving from left to right, the portfolio's annual average return for the past 3 years is 13.7%, the 5-year over 9%, and the 10-year average annual return is 8.2%. These returns are all net of fees, so they reflect the portfolio gains that go directly toward donor giving, supporting our community. All right, next, I would like to tell you a bit about the strategy and process that drives those investment outcomes. The committee's 10 volunteer members construct and manage the portfolio. The committee starts by making big picture strategic portfolio construction decisions, determining the optimal asset allocation across the portfolio. So getting a bit more granular, with each asset class, we construct a cohesive portfolio of managed investment funds. In doing so, we take a very hands-on approach to evaluating managers and desired market exposures. We consider the Foundation's investment objectives and values, and then we take a deep dive into the fund manager's strategies and performance, assessing how the funds will fit into our existing portfolio. We evaluate cost, risk, correlation, and of course, expected returns. So those are the decisions. The committee meets typically monthly, whether formally as a whole or in smaller asset subcommittee groups or in ad hoc meetings to affirm and reaffirm the portfolio strategy during unexpected geopolitical or market volatility. In terms of monitoring, we monitor markets and the portfolio performance, re-examining results and reassessing proactively or as needed. And then we report. We report our results formally to the Jewish Foundation Board, who serves the fund holders. So whereas the committee, whose role I've just described, constructs and manages the portfolio, the Foundation's outstanding professional finance team, led by Brian Arlen, guides and implements the policies, communicates with the fund holders, and manages and oversees money movement and fund diligence. And through all of this, our professional team of advisors at Mercer, led by Texas Himmelpard and Sean Wilkes, guide our content and metrics with data, manager oversight, and expert market views. They also bring us learnings and expertise about our peers and our competitors from their foundations and endowment teams across North America. And they will tell you more about that after my presentation. So how does that look in terms of actual portfolio construction? This next slide shows the Foundation's high-level asset allocation strategy. As I mentioned, the committee sets its target weights for each type of asset. So on the left, you will see we have a 70-30 portfolio strategy. That refers to 70% targeted to growth assets to drive returns up over the long term. The 30% invested in defensive assets is there to dampen volatility and provide countercyclical returns. So in years when markets are down, the defensive assets are relied upon to hold their value or even rise in value, giving a boost to returns and reducing volatility. So the bias is currently at 70% growth, rather than say 60-40 or a 50-50 split, which might be a more modest balance in a mature personal portfolio. But the 70% here reflects that as a perpetual endowment, its power is in compounding growth over the long term as markets rise, with time to manage through the bumps when markets dip. And now looking at what we invest the portfolio in, that's the pie chart. So on the right, we can see 8 pieces of asset classes in our portfolio. The blue pie pieces make up the 70% of our growth assets. It's a highly diversified approach to avoid any one market or asset driving our long-term returns. Growth assets consist of public and private equity, public and private credit, real assets, real estate, and infrastructure. The green pie pieces make up our defensive asset classes, which are traditional, high-quality fixed income, and non-traditional or alternative assets in low volatility, market-neutral hedge funds. And then notice there on the bottom left, the reference to Israel. Echoing Sarah's comments about Jewish giving being different, in our case, Jewish investing is also different. We have a deliberate over-allocation to Israel stocks and bonds of at least 3 times Israel's weight in the broad global market index. We continue to consider how to broaden that exposure even further. I know there were some questions on Israel investment, and we will give you more to come on that. For now, we are in bonds and stocks, but we look for more ways to increase our investment. And as you look at this picture of the asset classes of the entire fund, I'd love to share a few examples with you of the hands-on work the committee does, typically when we meet. Now, we will be having a meeting in a couple weeks, and during that meeting, we will reassess our big picture asset allocation mix. So along with that, we'll re-examine our private equity investment pacing model for the next 5 years. And in doing so, we'll reassess how much to invest, in which sectors, which geographies, and what life cycle investment stages we will choose to target. We will also review our public equity exposure to large versus mid versus small caps markets and decide targets there as well. And finally, we continue to hone our portfolio to the ideal passive versus active exposure in Canadian markets. As recently as last week, we were interviewing new Canadian asset managers to enhance our Canadian public market allocation. So it seems a good time to flash up the names of these 10 expert investment professionals on the committee that I've been referencing, who really do dedicate their time to this portfolio. I am sure you will recognize many of their names as leaders in the community. Our goal is to grow this fund responsibly. That means diversified assets, disciplined risk management, and a committee of 10 Jews, all of whom think they are the smartest person in the room. What could go wrong, right? No, but seriously, together as a committee, we check our egos at the door and truly work so well together, striving for a portfolio and results that generate as many philanthropic dollars as possible to support your giving to our community for generations to come. So thank you to each and every one of our committee members. And thank you to our donor fund holders for your continued confidence and support of the Jewish Foundation. And now I would love to throw it over to Texas and Sean from Mercer to cover peer perspectives and market outlook for 2026. Thank you.
Thank you, Stacy. On this slide, of course, is just what you just mentioned, Stacy, which is what we intend to cover. We're really thrilled to be here with all of you today. By way of just a quick introduction on this next page, yes, in this one, Mercer is a partner to our clients' portfolios in really all the ways that clients need an investment advisor, and it's not just one way, but multiple ways. You'll see on the right-hand side there, just underneath the institutionally focused, there are over 1,100 nonprofits like the Jewish Foundation who work with Mercer on investments, and 33 of those are other Jewish foundations and federations. We are perhaps one of the older firms doing this work, so the point on the right of time tested, we've served nonprofits for over 50 years, and of course Mercer is a global firm. Well, actually, I shouldn't say of course. You may or may not be aware that Mercer is very much a global firm, although Mercer itself has its roots in Canada, which some on this call may know or remember at some point. Finally, at the very bottom of the page here, under differentiated investment ideas, the point is that the work that we do with the Jewish Foundation and with all our clients is completely open architecture. That means there isn't a single platform that limits what we can consider or do for clients. That's quite different than nearly all our larger competitors, and one of the things that the Jewish Foundation benefits from just a broader perspective of being able to consider really everything. So with that introduction, I'd love to turn to data in a different way on the portfolio. So Stacy, you mentioned the overall strategy, asset allocation strategy for the foundation. And on this page, this is the goal of this page is at the title of the page here. How does the foundation's asset allocation strategy compare to peers? There's a lot on this page. I'd like to maybe orient folks on what it means and then call on Sean to provide a little perspective on where some of this data comes from. The takeaways don't necessarily jump off the page, so let me just explain. There are 6 groups of bars as you go from left to right. Each group of bars is a major asset class or type of investment. So on the far left, those tall bars that you see there, that's total public equity. What that means is that's just publicly traded stocks. Now, in that group, as well as all the groups of bars, the third bar over, in dark blue, is the Jewish Foundation. And we put it third because first and second are 2 measures of Canadian peers. On the far left in light blue, the larger Canadian peers, those over 500 million, and then the overall average, which is green. And then the fourth bar is US data. I'll get into that in a minute, but Sean, I wonder if I can call on you. Where did this Canadian data come from, and any other perspective there on that data source?
Sure, no problem, Texas. So our clients and prospects are always asking us how they compare to peers. And there is, in our opinion, sort of a dearth of readily available information. So we actually joined forces with CFA Societies Canada to lead a jointly sponsored Canadian Endowment and Foundation survey. And 2025 was actually the first edition, and we're planning to launch another edition in March. So essentially, we'll keep going with this year after year so we can sort of expand our insights, both on returns and like strategic asset mixes of larger organizations. I mean, maybe one thing I'll just highlight is, real assets. which would be infrastructure and real estate. We tend to find that's a lot higher in Canada and sort of the first foray into alternative assets for a lot of the endowment and foundation clients that we have. And private equity, I would say, no surprise, is generally significantly lower than what we see in the US. Maybe the only other thing I would say is, there is a pretty big difference, as you can see, sort of between the overall and the 500 million plus, between sort of how large endowments and foundations invest versus how smaller ones invest. So, something like total public fixed income, you can see larger organizations are typically lower in that because they have more alternative exposure, while the overall is higher, and that's sort of driven higher by how the smaller ENFs, so basically anything under 500 million, invest. So they're more into sort of total public portfolios and less into alternatives.
Yeah, thank you, Sean. And the punchline here really is that the Jewish Foundation isn't just doing what everyone else is doing, but has a differentiated strategy. So if you look at those dark blue bars going all the way across and compare it to the bars to the left, which would be Canadian, that light blue, light green, or to the US, which is in gray. And now that US is of endowment portfolios. You'll see that in some places the Jewish Foundation is a little higher, a little lower than both US as well as Canadian. And really what we're trying to do is what is right for the Jewish Foundation, given that the Jewish Foundation has certain needs on distributions and liquidity. So on things like private equity isn't going to have as high of an allocation as, say, U.S. endowments, but also can take a little more risk in some ways than the average Canadian long-term portfolio, which is why there's a little more in privates than on the far left-hand side of the page that you see in total public equity. Now, I think hopefully this gives you some sense here. Stacy, I think one of the things you mentioned is that this is one of the data sources that the Investment Advisory Committee uses, but it's more to inform what is everyone else doing and not to really guide of we need to be doing what other Canadian nonprofits or what even other US nonprofits are doing, just to inform where we are relative to where peers are. And hopefully this gives everyone on this call some idea of what the Jewish Foundation is doing differently than the rest of the market. So with this, the rest of the comments here have to do with what the future holds, and we can get into some detail. We thought we'd present a market outlook sort of at a glance on the next slide, which is maybe too simplistic of a slide here. And I'll admit maybe we've simplified this a bit too much, but you see on the far left-hand side, 2025 was all about artificial intelligence or AI. That's driven a lot of markets. It's driven a lot about what we've all been talking about as investors. And then there's been a lot of consensus around what should be driving growth going forward, consensus around even geopolitics until this year, where you see on the right-hand side here, we have an outlook paper, and one of the points is post-consensus, and I can go into that a little bit later. But one of the charts that comes out of that paper is this graph, and it might be too small type here for you to see. What we're showing here is a measure of global uncertainty. Now, this is not just market uncertainty, but uncertainty generally. And of course, we can measure that in markets, we can measure that in geopolitics, we can measure that in the probability of military conflicts around the world that could cause some economic strain. But this is a source that is put together that tries to weight all those things and just sort of averages things out. And what you see is that this graph goes all the way back to 2008, mid-year or so. And since 2008, really, there have been some spikes in that uncertainty. But what you really see, of course, is the most recent points over the past 17 years, that big spike up more recently there on the right-hand side of the chart. Now, I'd like to point out that uncertainty can be productive. And then, of course, as you see at the very top right of the chart here, uncertainty can also fall. Both those things can be very good for markets. So it's not that uncertainty is necessarily bad, but it is about balancing the risks and opportunities that's going to be really important in the work ahead for long-term investors that are navigating through this next market cycle. So if you were to take away just one picture, it would be this. And if anything, that makes the job of the Investment Advisory Committee and really all long-term investors just a little bit more difficult. There are some tailwinds as we look into 2026 more specifically, though, and that is this. Now, I think to summarize our views of the future on a page, we necessarily needed to use a lot of words. So I think so far we've shown some pictures and graphs here. Apologies for this word-heavy slide here, but you see we've organized our points, starting with global growth and getting into inflation. Inflation gets into things like interest rates, and then equity fundamentals or stocks. And what I'd like to do is just walk through each one of these briefly. Now, that top line, global growth, likely to continue accelerating. And that's even after last year, which ended up being a whole lot better than expected. There are some tailwinds around that global growth. There's some trade policy uncertainty that's been easing, AI-driven capital expenditures and productivity gains that maybe have been more on the margin, but are measurably positive. And then, as you'll see, as we'll talk about in a few pages, monetary and fiscal policies that are together very supportive of global growth. So, it's one of the tailwinds that in the face of uncertainty, the outlook for growth seems relatively positive. And inflationary pressures have receded. So that's second line down. And if it should recede, that should mean that most central banks will be able to ease a little bit from the inflation spikes that we've seen that central banks have been trying to control. That also supports markets generally. Equity fundamentals. Here we mean what are earnings for stocks projected to be, and we'll get into a chart on that in a moment, but they're solid. At the same time, valuations are expensive. We're paying a lot for $1 of future earnings based on the prices of most countries' stocks right now. Private equity. Stacey, you talked a little bit about the private assets that are part of our long-term strategy. And private equity has gone through a difficult time relative to public equity, but it's improving. Rates are moderating, which are helping the private world. But we'll get into that in just a moment. Real assets. I'm going to skip over that for just a moment. There are some positive valuation momentum, and then hedge funds. Hedge funds for some folks who've been in markets for a long time. That might be a dirty four-letter word, but hedge funds can be very, very helpful. And as Stacey mentioned, these are market neutral hedge funds that we're using in the portfolio, and they do really remain attractive, especially with dispersion within and across markets that fundamental hedge fund managers and some quantitative hedge fund managers are able to take advantage of. So, if I'm painting a somewhat rosy picture after the previous slide, showing a spike in uncertainty, this is generally positive overall. And it's because some of the data backs that. And that's not to say that there's not downside risks. But perhaps if we look at the next page, we get into just a few more pages here. We don't have a ton. We want to get to the Q&A, but just earnings. And this has to do with corporations and the support for debt as well as stock prices. DM is the first row. That's developed markets. The US is a very big part of markets, so we break out that country. EFI are all developed markets overall, and then Japan we call out specifically. And what you see is that the earnings growth rates in 2025, 2026 E is estimates, 2027 E is estimates as well. And then we've just color coded this for what the market pundits are. This is not Mercer's projections, but market pundits around this. On this, and generally very positive. So accelerating earnings even in the US, which is an expensive market already. But what you see is if you compare 2025 to 2026, some of the things I talked about on the previous page are behind some of these increases in the 2025 to 2026 increases in expected corporate earnings growth rate. So earnings acceleration helps stock prices, but this is what's expected. And if this is what's expected, that leads to some of the things on the following slide. This next slide is on valuations. And valuations is essentially how expensive are stocks relative to their histories, what we're showing here. Now, first, in the upper left-hand corner, we're showing some CAPE ratios. Now, these are PE ratios or price to earnings ratios that are cyclically adjusted, or essentially just looking at 10-year averages for PE ratios. So trying to smooth out the market cycles. And our point is in that subtitle in the upper left corner. It's elevated in most markets. What we're showing here, and I'll just explain the chart. There's three lines: a green, a blue, and a black line. The green is the Japan cape, and what you see is, and it may be surprising to see that green line so far above everyone else, and that's Japan. But this chart does go back to the late 90s, and some of you may remember that Japan was the darling market for quite a while and got quite expensive. And that's not a typo. The cyclically adjusted PE ratios were in the 50s and 60s as it spiked. But Japan's fallen, although has come back a little. The US is in that blue there, that brighter, darker blue. And of course, now if you look to the far right-hand side, the US relative to developed markets, which is the DM or the black line, is the most expensive market. That shouldn't be a surprise given the rise of the AI stocks and technology stocks, but that's ahead of developed markets in black, and then ahead of Japan, which is in green. And then the other thing that we do is to graph the 63rd, the 99th percentile for each of these. And what you see is that we are at very high valuations relative to history for developed markets, for the US in particular, for developed markets somewhat. And then Japan, we've graphed it at the 63rd percentile to make the point that the Japanese equities are relatively inexpensive. Now, we're not going to dump all US equities and move entirely into Japanese equities, but it gives you a sense for that there is some dispersion across different markets, and it's not just a US only market, which is all that tends to hit the headlines. Now, those of you that follow markets and maybe politics and geopolitics, you know there have been some elections in Japan just last week that really helped further the gains in Japanese equities. But valuations, the point is that the previous page, earnings doing well or projected to do well. Here on this page, stocks are somewhat expensive, and so we just have to be careful about the strategy. So, Stacy, you mentioned active versus passive. That is something that comes up. I think it comes up with every single one of our clients. It's coming up here as it relates to Canadian equities, and continues to be something that it's not a set a strategy and forget about it, but revisit it, and that is something that we'll continue to look at. Now, if we were to turn to the next page, interest rates are a really, really critical part of pricing for all capital markets, and then even, of course, investing in fixed income. And you see in the upper left-hand corner, moderating rate increases. In other words, central banks have been trying to fight inflation, which is what you see with those rising rising lines as you go from left to right. And that's likely to unless we have some surprises on inflation, likely to start to tip down, and we've seen that in some markets already. Now we're showing three major markets: the UK central bank here, and the rates in the UK in black, the United States in green, and then for a whole lot of reasons, Germany. We could show many other countries. And of course, the country we should have shown here is Canada. Sean, I know that's what we live and breathe all the time. Maybe I can turn it to you. So if we were to graph this for Canada, what's been happening with Canadian rates?
Well, so we would say we'd expect further easing by the Bank of Canada, and we think their policy rate will be sort of further below their estimate of 2.25%, as we sort of have a sluggish labor market and some bounded inflation that we think allows for some additional cuts. This is a consensus view, though, and I would say it's largely priced into bond markets. So just generally, I'd say we're pretty neutral on Canadian government bonds. We do think the yield curve may continue to steepen, though, if fiscal policy loosens, but we don't have any real strong views to own sort of short versus longer term bonds. So, I think the 30-year yield could be, going up slightly from its 3.8% rate or down. I would say it's kind of more difficult to predict, but the short-term rate certainly we see sort of as possibly falling down lower.
Yeah, thank you, Sean. That is very much the view across the rest of at least the developed world. And here I'm going to actually bring in one of the questions that was asked when the registrations for this webinar went out. There is a question around what will happen to U.S. Treasuries if global investors start reducing their holdings. There's also two other related questions. One of them is almost identical. I'll just read one of them, which is if U.S. interest rates go up, how would that impact markets? I think it is well known that the U.S. is not doing itself any favors politically with tariffs, everything else, to favor non-US investors to invest in the US markets, and that's putting pressure on the dollar that includes US Treasuries and sorry, the US dollar. And that's putting pressure on treasuries, which essentially means that if US or non-US investors start investing marginally less in US Treasuries, that will push up interest rates generally. Now, the US has a nominated Federal Reserve governor who has been in the past in favor of raising rates as opposed to lowering them in the current political regime. He's talking a lot more about lowering rates. Now, for the Federal Reserve, that means lowering short-term rates. So putting this together, Sean mentioned the yield curve steepening. And for those of you who are investors, you know what that means. For those of you that are not, essentially short-term rates go down, long-term rates go up. So whether that's 10-year rates, 30-year rates, go up, and that's very much what would be expected. The U.S. Federal Reserve Governor that's been nominated as chair would be in favor of reducing the U.S. Fed's balance sheet generally. In other words, not buying as much or even selling its own treasuries, which would push up interest rates. And so that combined with lowering interest rates just steepens the curve. That presents some interesting challenges for fixed income investors. I'll come to that in just a moment. There is this next page, which presents some further challenges for fixed income investors. The previous page was on interest rates generally, which have to do with government bonds, whether that's US Treasury bonds or Bank of Canada bonds. Or Bank of Canada and the Government of Canada bonds. Here we're looking at credit, which are borrowers, not governments, but corporate borrowers and other types of borrowers. And here, this is specifically high yield. In the upper left-hand corner, you'll see the punchline at the top, which is that global high yield default rates remain really low. If you think about where we've been economically, which is very positive, and where we expect to be, which is moderately positive as well, you'd expect that companies would be doing well and generally not defaulting. And that's what you see here, that this line are default rates in the high yield market. This is showing US data because US by far has the largest high yield market around the world, but it mirrors trends around the world as well. And first of all, the fact that default rates can be near zero and a few years later up as high as 16% is pretty remarkable. Of course, that spike in the middle of the graph is the global financial crisis. But even if you ignore that, there have been other significant increases and decreases that generally follow economic cycles. Now, we're at a point where default rates are really low. That could tick up if we do see headwinds and things don't play out the way the market pundits are expecting. We could see an increase in default rates, and that's really not good for investors overall. So, steepening yield curve, low default rates, and the potential for that to increase, that's really presenting some challenges as we look ahead to investing in fixed income. Now, there's one more page here before we get into the Q&A overall or the strategic work in the Q&A, and that's what's happening with private markets, private investments, whether that's private debt, private real assets or private equity, and all the flavors of private equity are an important part of the Jewish Foundation's portfolio. And what we've done here is, in a few words, try to summarize things. Private equity, a future focus is really looking at where there's a dearth of capital relative to the opportunity set. There are things like GP secondaries or capital solutions funds. If you know what that means, great. If you don't, it's essentially not the traditional way that a lot of private equity investors have been looking at investing. And we're starting we've done a lot of work there. We're starting to accelerate that more with more and more look at these sorts of things. Private debt tends to be historically has been lending to middle market companies. We're also looking a lot more at structured and specialty finance. It's not as funded as it could be with investor capital. On real assets, so these are things like commodities and real estate, infrastructure, those things, looking at core and core plus real estate. Real estate has not been favored globally that well over the last market cycle, and that's been really an interesting place to start to look, given the pricing that's been happening in the market. And then critical infrastructure, capital markets are much deeper for infrastructure today than they have been. And then finally, secondaries, that has to do with the private equity, so I'm just going to skip over that, but but just to mention that that's an increasing part of the future focus for capital for private markets overall. There's just one last slide here, which has to do with the title, the strategic work this year with the Jewish Foundation. And first thing is just to be clear, there are more than 3 things that the Investment Advisory Committee at the Jewish Foundation will be working on this year. But this slide just pulls out 3 particularly meaningful parts of the work for the Jewish Foundation's portfolio in 2026. Now, number 1 is fixed income. Hopefully you took that away from some of my comments, steepening yield curves, changing inflation regime, central banks changing the direction of where they're moving interest rates, and expensive high yield or expensive spread products, low default rates. We just need to reevaluate. Now, fixed income is bonds, for those of you that may or may not know that. And with all these things, it's really time to just reevaluate. Doesn't necessarily mean radically change, but reevaluate the foundation's fixed income strategy in this environment. Number 2 is some things that I talked about on the previous page: private markets refinement, investing in private markets. These things that are not publicly traded. It has all sorts of theoretical advantages, but that hasn't shown up in terrific results over the past year or 2 relative to public investments. So now I'll just say the data does not show anything that gives a reason to believe that investors should give up on private markets, but instead to refine what's happening. And then finally, values alignment. Values alignment refers to reflecting the foundation's mission and values, especially as a Jewish foundation, in the investment policy and in the investment portfolio. Now, the Jewish Foundation in Toronto was a pioneer among Jewish community foundations in having a statement and policy reflecting Jewish values. That was established several years ago. The world has changed. The needs in Israel, of course, have changed. And it's time to enhance the work that we're doing as a Jewish foundation to support the Jewish Foundation's mission. So that's it. I think we're going to turn to Q&A. I've answered a couple that have come through. I do see a few things in the chat. I'm just going to knock off 1 or 2 of these questions that have come in the chat more recently. I think it has to, the acronym is expense ratio. I believe the total investment expenses are roughly 0.5% when we do the weighted average, about 50 basis points or 0.5% overall. There's another question that has to do with what exposure the fund has to gold, directly or indirectly. It's almost entirely indirect. There are some managers that have the ability to hold gold, but they don't. So all of that is really mostly really indirect overall. Now, of course, there are some Canadian companies that are gold and gold mining companies. We have exposure to some of that in the overall portfolio, but hopefully you took away from the pie chart that Stacy presented that Canadian equities are just one piece of the overall global diversification, the global strategy that the Jewish Foundation has. There is a question that maybe, Stacy, I turn to you here, and it has to do with, this was a question that came in over the registrations, and how has the allocation of private equity changed over the last 5 to 10 years? And you showed the overall strategy, which is the target, but perhaps you could help provide some perspective on that.
Yes, sure. Thanks, Texas. So how's it changed over the last few years? Our target is 25% for all private assets. We are not at that target rate yet. That includes credit, equity, real estate, infrastructure for any private assets. We continue to ramp up, and so that is that pacing that I referenced, that it takes a lot of time to make sure we get the right assets in the portfolio. So I would say it has been increasing. It will continue to increase as we build the portfolio. I think we have a larger allocation than many of our peers, that we've managed to start that build early in good vintages. But as Texas mentioned, the last 2 years or year or so has been not the most outstanding performance, but we'll continue with targeting private equity as we go forward, private assets as we go forward. Texas,
Thank you.
I saw one other question I wanted to address. Someone asked what the long term is, and you could probably address that as well. But I thought that might be in reference to when I spoke about the target, the 7%. And I want to clarify that 7% is a minimum that we need to achieve, that we strive to achieve, and we will achieve, to cover inflation and distributions. and fees and things like that. So to make sure that we continue to maintain the capital base and grow it. Beyond that, we target higher returns than that, but that's where we set the minimum, and that changes based on inflation expectations and distribution requirements. So I think if that's where the question came from, I would see that as a base level, 7% and up. And in terms of long term, we look at beyond 10 years. It's a perpetual fund. We probably think of 25, but it's hard to invest with that in mind. So at least beyond 10.
Yes, and thank you. That the other part of that question were benchmarks and comparative performance. The Investment Advisory Committee receives a long report from us comparing against peers, comparing against market benchmarks. So what if the portfolio, the parts of the portfolio that are actively managed were not actively managed and were just in index funds? We also look relative to each investment manager's style. So, there's a lot of different benchmarks that are used. For the overall portfolio, meeting that long-term return is critical, but we also look at how the portfolio would have done if it were just invested passively, and I'm happy to report that those comparative statistics are pretty favorable for the Jewish Foundation overall. Let's see. I see a question that's come through about the percentage of valuations that are based on actual market values calculated daily versus appraised. The vast majority of the portfolio is liquid. So, Stacey, you mentioned the target allocation to private investments, which are those that price quarterly, not annually, but quarterly. That's a target of only a quarter of the portfolio. We're not even there. So it is the vast majority, over 80% of the portfolio that's appraised. So when we're showing the results, they are as real as we can make them. There is a little uncertainty as the private allocation grows, but perhaps whoever asked that question, you'll appreciate that U.S. endowments that have an average of 30-40% in private investments have a much bigger problem there overall. Let's see. Stacey, maybe we can both answer this one. There's one in the chat about concerns about a market correction and strategies to mitigate if or when that should occur. You presented asset allocation. I don't know if that's something you'd like to perhaps address.
I guess I would say, although I did sort of address it before, with the long-term outlook, we have to be strategic and less tactical and more strategic. We're in it for the long run. We have parts of the portfolio, that 30% defensive part of the portfolio that we believe will hold up well in a pullback. And as long as we don't have to take assets out, which we don't because we only have to take out that 4% required annual, we can ride out any pullback. There will be times when those numbers go down, but because we don't have to cash out the portfolio, we continue and wait until they return. And that is not to say wait passively, continue to improve the portfolio, but we don't have to cash out the portfolio. That's unlike someone who is retiring or has assets that they need to take out at any time. And that's why we can stick with that 70-30.
Yeah, that 70-30, that 30 is larger than what we see for some endowment portfolios, primarily for that reason. And to be able to take advantage of when there are market corrections, everybody's feeling really bad about current markets. That's a time that we should be actually thinking about proactively investing. And that's not an easy thing to do. And it's one of those things around discipline that can be very helpful. There are a couple of more questions around privates and the risk spectrum. A lot of things that long-term investors in private markets that folks have been investing in, as well as valuations are high. I mentioned that in equities, and credit spreads are extreme levels. In other words, they're tight, they're expensive. This is the reason for re-evaluating fixed income strategy for bonds, and then the active versus passive on the equity side of things. So I think we're looking at all of that. There are a few other questions here that have to do with the U.S. and how the U.S. is affecting the rest of the world. Of course, U.S. is one of the largest markets. So it is a very important sort of thing that we're watching. At the same time, the basic message that I hope that everyone here is taking away from that pie chart that Stacey presented is the strategy is to be diversified, not just invest in Canada or just the U.S., but really to spread things out. And that should really help. as we move forward into a period of heightened uncertainty. So with that, I think we're out of time, and it's Stacy. I think you're wrapping up on this one last slide.
All right. Well, I think that's just thank you for joining us. If you have any questions, seek us out, seek out the leaders at the Jewish Foundation, and we will answer any other questions you have offline. But thank you for your time. We look forward to hearing from you.